All right, then. So now that we all are settled, we are going to begin with the next round of discussion. This is going to have a sneak peek into the future. We've had so many discussions talking about how we all anticipated the digitization to come in, how it's already here. But from here on, what is going to be the future of this entire digital ecosystem that has been created right in front of us? We will be discussing riding the waves of change, the future of digital finance. And for that, firstly, I would like to call on stage our moderator, Mr. Vipul Jain, partner AZB and Partners. Can we have an applause for him, please? Joining him on stage, we've got an esteemed set of speakers. I would first like to call on stage Mr. Tashwinder Singh, MD and CEO at Niyogin, Mr. Xitij Kothi, co-founder at Vidyuttech, Mr. Harsh Pokharna, founder and CEO at OkCredit, Mr. David Jordan, MD at Enteruptors, Ms. Bhawna Sangwan, Chief Legal and Strategy Officer at Slice. Can we please have a huge round of applause for our panelists? I would now leave the stage and the mic as well to our moderator and speakers.
Thank you very much. As I'm sure most of you would agree, credit is critical for acceleration of any economic activity. Frictionless credit is even more necessary. Given this, the theme of this session, which is Waves of Change, Future of Digital Finance, I believe is an extremely topical theme for this session. The first broad theme that I think we should all be touching upon, and I would let each of the panelists share their view on that, is what do you think is the use case of artificial intelligence in digital finance? Case scenarios where this can be relevant, what could be the benefit, the risks, the challenges associated with artificial intelligence?
Yeah, maybe I can
Sure.
get the ball rolling on that one. So I just want to start by making a distinction between, so there's been, and a lot of work has already happened on the part of machine learning, data science, which is more or less table stakes now when you're looking at data-based underwriting. And now the new tech, which is being talked about a lot, is generative AI. So I'll probably focus my points around applications of generative AI in fintech today, right? Now, for fintech, tech, of course, is the biggest component and the biggest cost head. One of the lowest hanging fruit that we have, at least at Vidyuttech, also started experimenting with is how do you drive up developer productivity, right? Because that kind of impacts your biggest cost head significantly. And generating, developers have started using platforms like ChatGPT, etc., to develop their own codes. They've started migrating from Google to Stack Overflow. The advantages of this are these AI systems can understand your context and personalize the response for your organization, for your problem statement so well that it significantly reduces your time and effort that is required to develop the product. And you don't have, generally what happened in the past was you have solutions available on Google, Stack Overflow, your developers go read them and try to modify and convert them into context which is applicable to you, which still took a lot of time. So that is something that is the lowest hanging fruit that most of the fintechs, and I'm sure most of the organizations that at least I have talked to have also started experimenting with to a certain extent. The second part is about how you can use AI around the financial services part, right, which is your underwriting, collections, credit operations, etc. So here, essentially, there are possible solutions, but there are also challenges of how those solutions can be implemented. So I think first is around underwriting. So there's at least in the segment that we cater to, there are a bunch of consumers where you don't have data available. So what will the AI, what is the data you're going to ingest? What is the context that you're going to set for that AI to be able to give you some kind of a response, etc. So that is where we believe that we'll have to kind of get a little more innovative, look at alternate sources of data. Like, for example, we do a lot of assessment-based underwriting because the TG that we're going to underwrite doesn't have bank statement or there's no transactions in the bank statement. They're NTC. What else, what data do you have to underwrite them? So then you talk to them, you do a lot of personal discussions, video PDs, etc., to make a judgment call on whether you want to do that case or not. And this creates a very major people risk problem because it's that particular underwriter or risk person who's talking to that consumer and building that experience-based knowledge of how to underwrite such consumers. When that person goes away, your knowledge and experience goes away with that person. But say if you had a intelligent being in your organization which could access and process all of this data, you could actually store a lot of that knowledge within your organization, even when that person moves on. So use NLPs to transcribe those video PDs or audio conversations, and then use them to analyze how these past cases were underwritten, and then kind of apply them on your future cases. Now, of course, the challenge here is for an organization like ours, we don't have data. We can build or attempt to build the tech, but we'll take years to collate all of that data to train the models. Banks might have, or the old financial institutions will have a ton of data, but maybe they need support on the tech to process it and train those models. So I think there's not a trivial point that I'm making. It is very complex to execute, but it will take time and ages. Same thing can be implemented on other aspects, like on collections. When you're calling customers or interacting with them, the kind of response they give can be analyzed to predict timeline, your intent and ability to play. And you can implement SOPs which are very specific to certain consumers, that how do you deal with customer A versus customer B versus customer C, which is very cookie cutter today. So these are some of the areas where we are looking to leverage AI and some of the use cases where we think we can immediately impact.
So I concur. I think artificial intelligence is not just wishful thinking anymore. I think it's out there. The point is, how well is it going to actually be ingrained in a financial ecosystem to actually help facilitate lending? Because that penetration is extremely critical. Banks might have their own legacy issues. How fast the ecosystem changes and adapts to all of this will be, I think, the next big question. But would love to hear your thoughts. Tash?
Maybe I can probably add to what has been mentioned earlier. See, on generative AI, it's not limited to fintech or financial services, right? Any company which is trying to, or any coder who's trying to generate some code, can go to a AI site, and there are multiple, ChatGPT is one of them, there are multiple sites that are offering developers free code, right? It just expedites productivity, right? So what could take a day for a coder to make, today can be done maybe over 10, 15 minutes, provided you can articulate the problem statement clearly. For the AI to give you an answer, right? So to me, that's not limited to financial services, but it is relevant and certainly helps the financial services space. I think the two areas where it's very interesting how there are some examples where this is being used. One is obviously underwriting, because one of the big battles of credit has always been to improve the quality of underwriting, right? And underwriting fundamentally is dependent on the quality of data that's available, because you have better data, you'll be able to underwrite better. So, there's been a lot of strides that have been done, right? The account aggregator model, ability to get GST data, et cetera. These have all become par for the course. I think using AI and ML are the next level of improving your underwriting capability, right? So just pulling a GST data is not necessarily considered hot today. It used to be maybe 4 years ago. People thought, oh wow, you're using GST data to underwrite credit, which wasn't the case. Today it is par for the course, right? What I've seen in the US, there's a company which was doing on the collection side, the point that you made was very interesting. They were using artificial intelligence to make sure the call gets routed to that agent who's most suited to take that call, which meant that you needed behavioral data of both the caller as well as the agent. And the idea was that AI was actually managing on a real-time basis on who's the best person to answer the client call, which I thought was very, very unique. It was looking at data on who handled the previous call, what was the rating given of the previous call, who's the best person that can handle this conversation from a recovery standpoint, right? So some of those use cases are very interesting. I don't think there are too many companies in India that are actually using this today, but if you look to the West, I think there are a lot of companies that have started making inroads into trying to bring these up into specific use cases, right? So I think we need to get this done. We need to have a few situations where we are actively showing success stories out there. And I think the future is clearly in this space. So clearly this is a place that we all need to sort of move towards.
So again, just adding like our perspective, OkCredit's perspective on this is, so like if we think from a customer point of view, right? Like the customer who really wants the loan, for them, AI can definitely make the experience much easier. The entire journey, like be it from KYC to fraud detection to customer support and everything can really be automated using it, which makes it really seamless for them. Even at OkCredit, where we are serving around 3 million merchants every month, we have a support team of like 5 people, because a lot of that we have automated through AI, through conversational AI, collections and everything. So I would say that yes, like just to add, basically, even from a customer point of view, like integrating AI into your processes can make it really, really seamless and give you a competitive advantage.
So thank you very much for having me here. And I think the access to the credit is very critical for the economic growth of any country. And in India, there was a credit gap, and there was a huge effort that was made by the financial sector in order to bridge this gap. But I think over the last 10 years, what we have seen is that fintech actually played that critical role in terms of bringing the technology in order to solve that gap. And if we see the real reason on which the technology is working is to actually convert the unorganized factor of this lending into an organized form. And during this organization, the organizations were able to use artificial intelligence or machine learning. And I would say that it's not only limited to the extent of underwriting of that customer, but it's a change that is required at an ecosystem level, right, from where the data is coming. It may not be only with that organization. This data may be with the government. Just to give you a small example, the land records that are there today is not in a structured form. It's still unorganized. The day it takes a shape of an organized database, it's going to be a huge asset to this sector. And that's what I envisage as the future of digital lending, where the source of the data is not only the data that is sitting with the organization, which they have acquired, but the data which has been organized across the country, whether it's a tax data, whether it's a land record data, whether it is the data about the customer spending habits, which comes to the fintech, or for that matter, the financial service provider over a period of time, and using the AI and ML model that get converted into such a powerful form where this bridge of that excess of data is actually complete in every form. So I would say that the future lies broadly on the pillar of having a best-in-class technology, which also includes how exactly the technology will work. When we say about Web3 or a metaverse, how exactly this sector is going to adopt to those technology, and what are the organized data set that we will be able to envisage, add to that, and provide that service to the customers. The second part is definitely about the regulatory compliances. That's a very, very important pillar. While the technology may offer multiple solutions, but where exactly it stands in the regulatory compliance and the governance pillar. And if this regulatory compliance coupled with the technology comes with a product which comes, which can be offered to the customer in a digital form is somewhere the future will lie, where it will be stitched to the customer's need very closely, which will be offered by the financial sector.
Thanks. I'm probably coming from a slightly different angle on that, and sort of some of the things that we've been seeing in Australia, US, and UK. But I guess as you were saying about the regulatory issues, you have now a CEO who's responsible for things like responsible lending. So you can imagine the CEO standing in front of the judge saying, yes, we were doing responsible lending. That black box over there that I haven't got a clue what it's doing made the decision. So how does a senior executive demonstrate to regulators, to legislators, what that environment is? So we're talking to universities and Leeds in UK, in Australia, and just starting to talk to some universities here around decision experience about how to think about how we manage these decisions using AI and other environments. And there's lots of challenges that are coming through. For example, ethical considerations. So one of the problems is that from a human environment, we have biases, we have experiences that we've seen, and then we do machine learning. And what we're doing is we take our biases and our experiences and put it into that machine learning. But that machine learning now is creating AI that is discriminating based on those biases. So how do we avoid those environments? How do we enable the AI to keep changing with the environment? So if you consider financial exclusion, and you had people that had behaviors related to the difficulties that they had to get money, and then you start giving them a capability to get access to money, suddenly you're changing their behaviors. But the AI might still be judging them on where they were 3 years ago. So a lot of work is now trying to make sure that that AI is transparent, that people have confidence to say that what the AI is doing is the right thing. And I think a very important element, don't let AI make the decision alone. Keep having people involved, because when you really think about it, credit is about people. It's about human behavior. AI is not good at human behavior. What AI can do is to pick up lots of information that as a human being we don't have time to do it. But we still need to keep having that human input into the AI environment. So it's a bit of a perspective that I've seen from other countries in the world.
Crosstalk. So interesting point that you mentioned, David. I think this was one point that even our CTO used to bring up when we were talking about using AI to generate code, that a developer tomorrow will come and tell me that I didn't write the code, GPT wrote the code, so don't penalize me. So I think what is very important is the organizations will have to structure themselves to be AI ready. And in that sense, how do you have the review mechanisms in place, accountability in place? As core as even your tech architecture will probably have to be adaptive to AI, because the way you design them so that it's easy for the AI to, for example, know your schema of the database so that it can give you better and more accurate results. So a lot of those things will have to come in place. Like, for example, underwriting decisions, I don't think we need to kind of let AI make the decisions and give an instant sanction to a customer. But what it can do is, in majority of cases, help us bring down the cost of underwriting, right? Like, wherever, for example, data is unstructured. You talked about structured data, unstructured data. I think probably AI has the leverage to also make sense out of unstructured data, right? That's what large language models will do. And make decision-making faster. Eventually, it will still be taken at the, by a human. But it can bring down those cost of underwriting in cases where today the underwriting is very high touch. You have to go meet the person, talk to them, discuss with them, which takes time and money. So I think that's the power of AI that can be at least unleashed quite quickly.
And just to add, David, to your point, I'll bit differ on that. And the point of difference is about the regulation and compliance and impact on the fintech. So I think there was a phase where the innovation was superseding the regulation, right? And at that point in time, there was some disruption by the regulation. But I think today we have reached that stage, at least in India, where the regulator is actually proactive. The kind of engagement we happen, is outstanding and unprecedented in the history. The thought process is also to include technology. Gone are the days when we have to explain, what we are trying to build. Is there a gap? Yes, there is definitely a huge gap which we can try and cover. But I truly believe that more regulation will enable this industry, because it is going to provide the framework, it is going to provide the stability, it is going to provide the predictability. And if from an organization standpoint, if we think, then if we have 3 pillars, which is transparency, security, and accountability, if these 3 things are built in the fintech entire process, then more or less, I think we will be on the intent of the regulation and the way the regulator would like us to work on. Most of the fintech, when they start their tech first, it's more of a tech fin, where more technology and less of a fin part. And I think the reg part is also critical. So somewhere it is very important. I would say it's the soul of this sector, without which the growth or the future may not be possible for this sector to attain the way to the best of its ability.
No, I completely concur. I think whilst AI, ML are all good things and extremely important for the future of credit as well, I think a regulatory framework is the need of the hour, because ultimately a CEO can't essentially come around and say that the software is responsible and not me. Right? There has to be a structure in place, there has to be ownership, and there has to be responsibility. And like Bhawna said, the regulatory framework therefore takes precedence. Now, latching onto that, the next topic, which I think is extremely important, given the topical theme here, is what is the sense that each of you have in terms of the regulatory scrutiny and the regulatory environment in India. What has been your experience? I have my own thoughts, which I'll perhaps share at the end. Don't want to color anybody's thoughts. But do you believe that the regulatory scrutiny, the regulatory environment today is conducive to business, is conducive to growth, or is it actually scuttling growth?
So I think maybe I can start on this part, right? I think we need to start using words like growth, innovation, etc., and see where regulation plays a part in that. Is it really helping innovation or is it holding back innovation? I think, but before we get into that path, one point becomes very clear if you see the way the regulations in this country have evolved over the last couple of years, right? Last couple of years have been very interesting from a fintech standpoint because as Bhawna rightly pointed out, that I think fintech has moved ahead of regulation, and over time regulation has caught up, and now I think we're at a different stage. But fundamentally, where are we in our evolution? Is fintech here to disrupt, or is fintech here to partner? I think if you look at the first wave of fintech, there was more talk about disruption, right? And I think the regulator has come back, at least to my mind, I see it very clear, that the regulator is telling us that you're not here to disrupt, you are here to partner. You are here to extend the network that exists, extend the product stack that exists, make it easier for people to get access, reduce the cost of the delivery of services. Because don't forget, India still has 800 million people that live in rural India. I run a company called Niyogin. Niyogin in Sanskrit stands for empowerment, and therefore this is very close to my heart as to what we do with whatever we deliver or what we create. Are we disrupting the environment, or are we partnering with existing players and extending a more efficient way to provide delivery of financial services? I think that part, in my mind, has to be very clear in everyone who's running a business, is what is it that you're trying to achieve? Because the regulator, to my mind, is very clear. The regulator has not been kind to disruptive businesses, because disruptive businesses haven't taken the effort to go and take regulatory approvals if required. And sometimes you don't even know if you need a regulatory approval because there was no framework, right? So to be fair to the businesses. But I think the direction in which the regulations in this country are playing out, I think is very clear. Similar thing happens when you talk about, since we are discussing lending, you talk about FLDG guidelines, right? There's been a lot of to and fro, but eventually the clarity has come through from the regulator on what you can do and what you cannot do. And again,
There was a balance.
there was a balance, and the balance was driven towards partnership, saying, yes, you are allowed, there is a certain percentage you can take, but you can't give up your core job of taking risk, right? So you can get some risk defeasance that you can do, but it's not 100%, right? So to me, getting that clarity of thought is very clear. It solves all the questions that you asked, that is it helping, not helping. If you put that framework, then your innovation has to be from a partnership-led approach. There's no one holding you back. If your innovation is from a disruptive approach, yes, there are things that are holding you back. I'll pause here.
Yeah. No, so I think like I can share view as a LSP, because we are not a regulated entity ourselves, so we don't directly interact with regulators. But what we have seen, like number one, I 100% agree that their customer protection is really, really important. There have been a lot of instances where people are mis-selling loans, charging exorbitant rates, collection practices are bad, and the customers should be protected against that. So that's very important. And I also, but in the short term, I see that all of these regulatory changes have been a bumpy road, especially for companies like us, because now when we go to regulators, there's a lot more to regulated entities, there's more scrutiny. People are busy fixing their existing partnerships and taking a backseat on new partnerships. So things have been bumpy in the short term, but what I have been observing is that now more and more clarity is getting there, like in the internal teams, in the legal compliances, even the management teams. And now, once we achieve that more, I think like we do have the opportunity to scale to the next level. I believe this is like the work we are doing to enable scaling to the next level. So I'm in favor of all the regulation that is happening. It's good for customers, it's good for players like us, which are getting clarity on what are my role, what is someone else's role, and now we can scale forward from there.
So I agree with all the points. As I've mentioned, I think the regulations are the integral part of this industry. It's a very important pillar. So far, I think even on the fintech side, if we talk, most of the fintech were looking for a mean by which they can be not included in the license regime, or for that matter, there are light touch regulation framework that may be implemented. But we've reached at a stage where if you really want to have a meaningful impact in the given industry, there is no way that we cannot adopt to the regulations. And the beauty of this industry is that unlike banking, the regulations are also evolving. So I would say that there has been an immense work that has happened on regulation. There is the kind of action that we have seen in last 1 year, starting from digital lending guideline, FLDG, recognition to the digital lending apps. Then even if we talk about the recent one, frictionless credit, the most important one, the bank issued line of credit on UPI. It's an actually innovation by the regulator, which have been given to the industry. It's actually a doors which have been opened. Yes, there is a long way for us. Why not small finance bank or why not NBFC is definitely the questions for which we will continue to ask and push the envelope. But it's a great beginning that the regulator has offered. I think what is critical at this stage is for the fintech industry also to be taking the equal responsible charter to the extent that regulatory compliance is concerned. So I would say that if we look into future, it is all about how precisely we can try and get to the intent of the regulation and try and do innovation within that area. It is a slow process. Obviously, the regulator doesn't want any disruption. But ultimately, it is something that this industry is looking and this country want, which is more about stability of the entire sector and the growth of the sector, which can be maintained, keeping the larger risk at a country level, keeping a customer at the center, keeping the right level playing field in the industry, and also ensuring there are principle-based regulations so that there are no restrictions that can be levied on one industry participant vis-a-vis other industry participant. So considering that, in my view, the regulations have evolved and it is good for the industry. And I really hope the future look where the regulations are equally predictable.
Right. Yeah. So, taking a step back, any country's growth is directly related to the credit growth, and I think the regulator's job is to make sure nobody is introducing any large-scale systemic risk, and which is the role of the regulator, and I think they are doing a very good job about it. As fintechs or LSPs, I think my personal view is that we should tackle regulation head-on. I mean, it is table stakes now. You need to know what space you are entering and what are the core regulations, and then build your business around it. And regulations keep coming in, right? There are iterations that keep coming in, and there is always scope for building a business on regulatory arbitrage. But that, in my view, is a very shortcut or a short-lived idea or a venture. Sooner or later, regulation will catch up, and you will be disrupted. So, at the end of the day, fintech's job is, maybe categorized into 3 or 4 or 5 objectives, right? Are you increasing access of credit to a segment which was not available? Are you reducing the cost of serving credit? Ease of repayments, making transactions simpler, easier, etc. As long as one of those core value propositions are being delivered, it is, very much possible to build disruptive fintech businesses, which are within the bounds of regulation. And it's not a race to, the largest transaction volume or largest loan book, etc. for a startup. When we started out, we also were hungry for growth, right? And it is critical. Like, a lot of your future depends on how you're growing, how fast you're growing, the momentum you've built. But, it's easy to kind of put an oversight on regulation when you're driven by these goals. But I think that it's okay to grow slow, but tackle those regulations head on and grow in a manner which is sustainable, so that tomorrow, even if regulation catches up, your core business is not disrupted. Because at a scale, that becomes even more challenging to manage.
Thanks. I guess there's an interesting thing for fintechs or tech fins, is that whilst you might not be regulated, if anybody wants to use you, they need to know that you fit within their compliance requirements. So you have to really understand that environment. But I think also the interesting thing that's coming out is that I'm seeing quite a difference between the way the bank thinks about regulation and what the regulators think about regulation. So we're moving from this sort of checkbox compliance, did I tick this one off, to trying to be a lot more progressive in what you're doing to try and avoid risk to your customers' money. The other side of it is that everything that's happening at the moment is from a historical perspective. We've come from a world where we looked at things back, what happened to the customer last year, not what we think the customer's going forward. So in Australia, a good example is when you want to get a loan, you're going to have to show last year's tax return. Now, the bank thinks this is a great idea, that it protects them from responsible lending. What the regulator is saying is, we don't care if the customer had a job last year. We want to know if they got a job next year and the year after. So whilst the bank is thinking that they're protecting themselves, the regulators are actually getting frustrated with them. But it's also changing the way things like international financial reporting standards, where the probability of default now has to be calculated at the time of funding, not when the customer gets into trouble. So when you start thinking about that, we should stop trying to think about looking historically and building a trend about the customer and start thinking the way the IFRS systems work about trying to understand the forward risk. So this is sort of really a good time to have a thought about how these changing regulations can fine-tune your products to make them more compatible with the banking partners and other financial service partners that you work with.
Well, thank you very much. That's very insightful. I think now my thoughts on this subject, having worked with a lot of fintechs in this space, is that, first of all, I completely concur with you that people have moved towards taking advantage, people have moved away from taking advantage vis-a-vis regulatory arbitrage. That is not the model of the future. People are more focused on regulatory compliances. They are happy to go and get a registration because they understand that the longevity of their project, the longevity of their venture is going to be contingent upon regulatory blessing. My personal views are when it comes to regulatory catch-up, which has happened so many times over the course of the past few years, a better approach might be, like Bhawna also mentioned, for the regulator to focus on principal-level legislation, principal-level regulation, because that will actually enable product innovation, that will enable product structuring, that will enable fintechs to come up with new partnership models which will benefit not just them, but the banks, because they depend on the fintechs for the customer acquisition. Let's be very clear. It's not just the fintechs which depend on the legacy old financial institutions, it's the other way around as well. So as long as we have that principle-based regulation construct, the regulatory catch-up will also diminish, right? So I think that's how the ecosystem needs to move forward. I think the regulator is playing a decisive role in that direction, but there's still lots that needs to be done. I mean, we really can't have a space which is been in the market, which is exploding, but there is no clarity on whether there is a regulatory issue with that or not. I mean, crypto is a perfect example that we all know about. So I think those are the kind of situations which need to be avoided for us to develop as a sector. But thank you very much for that. I think the last theme that I think we should all just kind of share our thoughts about is...
So before you move on, I do want to recognize and give credit to the fintech sector, because the fintech sector actually has identified areas where there was no regulation. It has actually done that, and it has actually forced the regulator to think that, oh, we should think about regulation. So we should give credit.
That's catch-up. That's catch-up.
Well, I think it's innovation. Innovation, right?
Innovation for the fintechs and catch-up for the regulator.
Yeah, the point is that it is catch-up for the regulator, rightfully so. And what comes at the end of all of it is that you have a much better regulated and organized setup. But the point with all businesses, if you go back into the history of mankind, has always been that regulations have always played catch-up, because the human mind is so inventive and so innovative that they always try and find ways and means of figuring out, okay, what is a place for me to create a business because there's an opportunity sitting out there. The regulator does not need to think through every possible opportunity that exists till somebody goes and does something about it. And that's exactly how regulations evolve. So, I think, just to complete my point, I think regulations will keep evolving. It will become more and more clear. I totally agree we should not be working on regulatory arbitrage. But to me, there are still a lot of places where there is incremental regulation that is still required. And to your point, the principal level regulation, I think, is the exact point that should be made, that there have to be some principal level regulations which give direction to people, which decide what kind of innovation you can do and not do, right? And that's why my view, fundamentally, as I started, was that if one puts the balance of figuring out on what is this innovation doing, is it partnering to extend an existing framework that exists, and therefore partnership is the benefit of this innovation. I think broadly I've seen, at least in my experience, that the regulator is very supportive of that. Disruptive innovation is where the regulator starts thinking what kind of regulation I should bring about. Both good and bad. I mean, there are disruptive regulations which the regulator has also accepted, and there are some disruptive regulations which the regulator has basically shut down. Right? So I think we've seen both kinds. So that's just
No, and
my
it
point of
becomes
view.
very important to understand what are the key facets which are non-negotiables for the regulator. All of us would have heard the spirit of the regulation very often, right? A lot of times lawyers will tell you that this might not be the letter of the law, but this is the spirit of the regulation. As long as those non-negotiables are taken care of, I think the regulator should be comfortable. But then we need to move the regulator away from granularity in terms of prescription to a principle-based architecture.
All the best with that, yeah. You're going to move the regulator away.
No, but you'd be surprised. We work very closely with the regulators, and that's how they're actually thinking about things now, because they don't want to have a new amendment coming out every second day.
I'll give you an example of a problem in the United States. So the regulators have become prescriptive in the United States. So they say, gee, JP Morgan did this or Credit Suisse did that. So we create this prescriptive one. And there's a credit union dealing with, the unbanked of the United States, loaded with this incredible prescriptive regulation that has no fit to their customer base. And that's a really big problem of example of prescriptive, where Australia and UK have been moved more away from prescriptive and saying, we're going to say, you need to make sure you don't lose the customer's money. How you do that's your responsibility.
Absolutely.
But if you do it wrong, we're going to whack you around.
Absolutely. So I think we're out of time. So just last thoughts. Any thoughts on how to increase credit penetration in India? Any examples? Any thing you guys want to share?
I can take this one. So at OkCredit, I think one of the very big ways of increasing credit penetration is by digitizing the economy. And at OkCredit, for example, so we digitize all of their receivables and payables transactions, which for a long while have been written in copy and pen paper. So while we are bringing all of that online, we use that intelligence to create an informal credit score for all of our merchants and use that to lend. And over time, we are seeing NBFCs, banks acknowledge that score and use that. And I'll give you some data, right? For example, 20% of our loan applications are new to credit, where there's no CIBIL score. And because of our data, we are able to give loans to them and build a credit score for them and include them in the formal economy. Another 20% are people who have a bad CIBIL score for some reason, maybe a mistake in the past. But now seeing their behavior on OkCredit, we are again giving them credit and helping them improve that credit score. So again, bringing them into the formal economy. So I am a true believer of digitization being that thing which can increase the penetration.
Yeah, so I would say the magic wand is on two pillars. The first is definitely the profitability, which will come from the various products that the industry will do. And second is definitely about the compliance framework and complying with the regulations.
Yeah, no, I think to echo what even Bhawna said earlier and what even Harsh is saying, right, that digitization of data will be key, right? So right now, there's small sets of data points that we look at when we are trying to give credit to anyone. But there are a lot of other data points available, like, for example, house ownership proof or khata data, etc., electricity bills, what they are spending, where they are spending. If we are able to, and this requires a much more collective effort, but if we continue to work towards that digitization journey, sooner or later, there will be possibility, it is possible to access all of that data to underwrite. SaaS companies or fintechs, right, they are coming to banks and partnering with them and saying that we have these alternate sources of data, and you can use this to give access to consumers which you are not able to underwrite today. So yeah, my bet is on driving digitization very aggressively.
Yeah, I think one of the things that I talk a lot to financial institutions around the world, I usually use this quote and saying, data-driven banks discriminate against divorced women who have no data. And I really try to get people to think about it, because what we are doing with data and analytics at the moment is saying we need a vanilla customer. And the majority of people are not vanilla customers. So what you need to do is to use the data and the AI, not to create a vanilla customer, but to really understand the diversity of psychologies and mentalities of different people, different cultures, different environments, and then get the banking and lending systems to fit with that. So I think this is where the digitizing AI is really important, because vanillization was when we were trying to do things manually and we just did the 80-20 rules. But now with AI and digitalization, we don't have to do that, and I think that's a very important part to solving the problem.
I think if I may just probably use and have the last word on this, because I'm the last speaker. But I think this is an interesting and a very important question. But you know, if you look at the way lending happens, and I know we're out of time, I break it up into 3 buckets. There is the client acquisition, there is the underwriting, and there is the collection. Right? On underwriting, at least what I've seen is that a lot of models have become reasonably standardized. Whether it is home record data, GST data, CIBIL data, non-CIBIL data, you know, new to credit. There are some standardized methods that people are using, and you know, account aggregator models, etc., are all leading to making the underwriting process pretty standardized. And AI will come in, make that a little better. I think everybody will have access to all that data, and therefore that will become okay. The issue really is about acquiring the customer and collecting from the customer, right? That is where I think a lot of people spend a lot of their cost, right? And I think the efficiency that a lending institution can create for itself is if it can find better methods of originating the customer and collecting from the customer, right? To me, penetration is about that. Penetration is about getting access, increasing your hopper to see more people coming in through the pipe for your institution, saying that, okay, we want a loan, getting more people there, and using technology, to your point, totally agree. But the technology that you and I are differing about is, you were talking about the underwriting process, I'm talking more about acquiring the customer process. The acquisition of the customer in an efficient manner, I think is super important for us to be able to penetrate and to get more customers. You have a larger hopper, you'll lend to more people. I mean, it's just, you know, natural how that works, right? And then, don't forget, we don't talk much about this, but there is no point in starting a lending business if you don't have a collection infrastructure. It's very, at least in India. So focusing on that piece, before you really focus on getting the customer, I think is also super critical for you to really have a sustainable business, because that's what you want to build, right?
Well, thank you very much.
Thank you.
Thank you.
Thank you.
Thank you, guys.